projected 25% decline in real estate manufacturing and technology sectors by Q2 2025, global competitors positioning themselves for market share amidst China's economic turmoil. Overview. As of early 2025, projections indicate a significant decline of approximately 25% in the real estate manufacturing and technology sectors, primarily attributed to the ongoing economic turmoil in China. This anticipated downturn is expected to have far-reaching implications for both the domestic and global markets as international competitors position themselves to capture market share during this period of instability. Economic context. China's economic landscape has been under severe strain, with GDP growth estimates for 2024 hovering between 2.4% and 2.8%, a stark contrast to the government's claims of nearly 5% growth. The crux of this downturn lies in the implosion of the property sector, which has adversely affected local government revenue and consumer spending. By the end of 2024, new property developments had fallen by 23%. And property completions had decreased by 26.2%. This collapse has not only hampered the real estate sector but also sent shockwaves through the manufacturing industry, which relies heavily on construction and infrastructure projects. Sector-specific impacts. 1. Real estate. The commercial real estate (CRE) sector is grappling with heightened interest rates and inflation, compelling organizations to adopt defensive stances. Despite these challenges, a recent survey revealed that 88% of CRE executives expect revenue increases in 2025, contrasting sharply with previous expectations of declines. However, the office real estate segment continues to struggle due to persistent remote work trends and elevated vacancy rates. 2. Manufacturing. Manufacturing remains a cornerstone of the Chinese economy, contributing around 30% to global output. Yet the sector faces declining exports and foreign direct investments, signaling reduced demand. Although the manufacturing value-added growth rate has been resilient, staying above 5% in 2024, the overall outlook is cautious as global competitors seek to capture market share from Chinese manufacturers. 3. Technology. The technology sector, which is intertwined with both real estate and manufacturing, is encountering challenges such as rising protectionism and a pressing need for innovation. Companies are focusing on integrating advanced technologies like AI to enhance efficiency, though the broader economic slowdown poses risks to investment in these advancements. Global competitive landscape. As China's economy falters, global competitors are strategizing to capitalize on the shifting market dynamics. Countries like India, Vietnam, and Mexico are emerging as attractive alternatives for investment, particularly in manufacturing and technology sectors. For instance, India continues to bolster its manufacturing capabilities, while Vietnam benefits from companies seeking to diversify their supply chains away from China. Key contributing factors. Declining government investment. Local government investment has been stymied by plummeting revenues from land sales, which have historically funded infrastructure projects. Consumer confidence. Low consumer confidence, exacerbated by deflationary pressures, has led to reduced household spending, negatively impacting economic growth. International trade tensions. Ongoing trade tensions, particularly with the United States, have prompted companies to rethink their supply chains and geographic investments. Timeline of events. 2022 to 2023, the Chinese property market began to show signs of distress, leading to a significant decline in construction activities and local government revenues. 2024 GDP growth estimates reveal a sharp decline, with the introduction of a substantial refinancing plan aimed at local government debt. Q1 2025 projections indicate a further 25% decline across critical sectors, prompting global competitors to prepare for increased market share. Conclusion. The projected decline in the real estate, manufacturing, and technology sectors by mid-2025 underscores a pivotal moment for the Chinese economy amidst its ongoing turmoil. As international competitors position themselves to seize market opportunities, The global economic landscape is poised for significant shifts in market share and competitive strategies. Key insights from sources. 1. China Manufacturing Industry Tracker. Source 1 highlights the resilience of China's manufacturing sector amidst declining demand and investment. 2. After the fall, China's economy in 2025. Source 2 emphasizes the disconnect between official GDP growth figures and the reality of a struggling economy. 3. Deloitte's 2025 Commercial Real Estate Outlook. Source 3 reflects a shift in sentiment among CRE leaders, signaling cautious optimism for recovery despite ongoing challenges. This comprehensive examination illustrates the intricate interplay of domestic and global economic factors, leading to a landscape where competitive dynamics are rapidly evolving as China confronts its economic challenges. Counterintuitive information in the content. 1. Optimism amid decline. While the projected decline of 25% in the real estate, manufacturing, and technology sectors is alarming, the sentiment among business leaders shows a surprising optimism. Specifically, 88% of respondents in the commercial real estate industry expect revenue increases in 2025, which contrasts sharply with the dire predictions for sector performance. This highlights a disconnect between expected market performance and the confidence of industry professionals. 2. Manufacturing resilience. Despite facing significant challenges, China's manufacturing sector is reported to maintain a growth rate above 5% in value-added terms. This resilience stands in stark contrast to the overall economic downturn, suggesting that while the sector is under pressure, it retains foundational strength. The notion that a sector can thrive even as it faces declining exports and increased competition is counterintuitive to typical market behavior. 3. External investment and market share. The expectation that global competitors will capture market share from China amidst its economic troubles is another area of counterintuitive logic. Typically, one would expect a major economic player like China to dominate. Yet the current situation indicates an opportunity for others to exploit China's weaknesses. The anticipation of a 25% decline not only signals a loss for China but also suggests an unexpected advantage for global competitors. For varied sector performance, the commercial real estate sector exhibits a unique divergence in performance expectations. While office spaces face significant challenges due to high vacancy rates and changing work patterns, sectors such as logistics, multifamily housing, and digital economy properties are expected to thrive. This juxtaposition of fortunes within the same overarching industry is not commonly seen, as one would expect widespread challenges to affect all segments similarly. 5. Impact of technology integration. The technology sector, while also projected for decline, is seeing a significant shift towards integrating AI and innovative technologies. This suggests that even amid economic downturns, companies are pivoting towards technological advancements as a means of survival and competitiveness. The notion that firms can focus on innovation during tough times contradicts the idea that companies would typically cut back on R&D and tech investments when facing economic pressure. 6. Consumer confidence versus economic data. There is a striking contrast between consumer confidence indicators and actual economic performance metrics. While official GDP growth numbers for China may show modest improvement, indicators such as retail sales and consumer confidence suggest a more pessimistic view. This raises questions about the reliability and interpretation of economic data, revealing a potential gap between perceived and actual economic health. 7. Rising protectionism and global trade dynamics. The anticipated rise in protectionism globally, particularly from the U.S., poses a paradox where China faces both challenges in maintaining its export strength and opportunities to reshape its trade relationships. While one would expect protectionist measures to isolate economies, they may instead compel China to diversify and strengthen ties with other markets, which could lead to unexpected collaborations in trade dynamics. 8. Fiscal measures and economic recovery. The introduction of substantial refinancing plans for local governments indicates a proactive approach to addressing economic decline. This is counterintuitive to the expectation that governments in distress would retreat from spending. Instead, the push for liquidity and government investment can be seen as a potential catalyst for recovery, contrary to typical austerity measures observed in times of economic downturn. 9. Long-term effects of immediate challenges. The idea that immediate economic challenges could lead to long-term structural changes in the economy is noteworthy. While sectors may be declining in the short term, the adaptations and innovations driven by current pressures could foster a more resilient economy in the long run. This concept challenges the traditional view that downturns solely lead to negative outcomes without potential for positive transformation. 10. Changing work dynamics. The ongoing evolution of work patterns, particularly the shift towards hybrid and remote models, has created unexpected pressures on certain commercial real estate segments while simultaneously opening opportunities in others. The expectation that some office spaces would rebound despite prevailing trends towards remote work is counterintuitive, as one would logically assume a more universal decline in office demand. In summary, the economic projections and sentiment surrounding China's downturn reveal a complex landscape where counterintuitive trends and outcomes challenge conventional wisdom. The juxtaposition of optimism against projected decline, sector-specific resilience amidst broader challenges, and the potential for innovation to emerge from adversity all illustrate a nuanced understanding of market dynamics in the face of economic turmoil. The report on the projected 25% decline in the real estate, manufacturing and technology sectors by Q2 2025 amidst China's economic turmoil contains several nuanced insights that many may overlook. Here are key points of significance that deserve closer examination. 1. Authority bias in economic reporting. The report highlights the concept of authority bias, which refers to the tendency to accept the official figures reported by the Chinese government without skepticism. This bias can lead to a distorted understanding of the actual economic conditions in China. The significance here is profound. Relying on potentially inflated or manipulated data can mislead investors and policymakers, affecting decisions in global markets. Recognizing this bias is crucial for stakeholders who depend on accurate economic assessments to strategize their investments and operational plans. 2. Income disparities and consumption patterns. While the report discusses GDP figures and overall economic performance, it does not delve deeply into the disparities in income levels across different regions in China. This is significant because regional income disparities can shape consumption patterns. If wealth concentration remains high in urban centers while rural areas lag, the recovery in consumer spending may be uneven, influencing sectors differently. Understanding these dynamics is crucial for businesses looking to enter or expand in the Chinese market. 3. Impact of real estate on local government financing. The report touches on the collapse of the real estate sector and its implications for local government financing, yet it does not fully explore how local governments reliant on land sales for revenue are particularly vulnerable. The significance here lies in the potential for increased local government debt as they attempt to stimulate growth through infrastructure projects. This could lead to a systemic risk where local governments become unable to service their debts, which would further exacerbate economic instability. 4. Global competitors capitalizing on China's decline. The report suggests that global competitors are positioning themselves to capture market share as China's economy falters. This point is often understated in analyses focusing solely on China's decline. However, it is significant because it indicates a shifting landscape in global trade dynamics. Companies in other countries may find opportunities to fill gaps left by China, leading to a potential realignment of supply chains. Stakeholders should closely monitor how this competitive landscape evolves, as it may present new opportunities for collaboration or competition. 5. The role of technology and AI adoption. The intersection of technology, specifically AI, in traditional sectors like manufacturing and real estate is mentioned, but the implications are deeper. The report notes that companies are increasingly integrating AI for operational efficiency amidst economic challenges. This is significant because firms that successfully adopt and leverage AI could emerge stronger post-recession, gaining a competitive edge. This trend could reshape industries and create winners and losers based on technological adoption, urging businesses to prioritize digital transformation to remain relevant. 6. Sector-specific recovery outlooks. While there is mention of optimism within the commercial real estate sector, particularly regarding revenue increases, the report does not elaborate on the varying recovery rates across different segments, e.g., industrial versus office space. This nuance is significant because it indicates that not all sectors will recover uniformly, and some may continue to struggle with high vacancy rates and changing work patterns. Understanding these sector-specific dynamics can help investors make informed decisions about where to allocate resources. 7. Long-term structural reforms needed. The report implies that short-term stimulus measures may not suffice to address the underlying structural issues within the Chinese economy. This is significant as it suggests that sustainable recovery will require comprehensive reforms in areas such as property rights, local government financing, and consumer confidence. Stakeholders should be aware that without addressing these structural challenges, any economic recovery may be short-lived. 8. Environmental considerations in recovery strategies. The report briefly mentions sustainability and environmental pressures but does not delve into how these factors will influence sector recovery. This is significant because as global attention shifts towards sustainability, industries that fail to adapt may face increased scrutiny and investment risks. Companies that proactively integrate sustainable practices into their recovery strategies could not only mitigate risks but also attract investment from a growing pool of socially responsible investors. 9. The potential for geopolitical tensions to escalate. While the report outlines economic factors influencing the decline in various sectors, it does not fully address the potential for geopolitical tensions to exacerbate these issues. The significance here lies in the interconnectedness of global markets. As China's economic power wanes, other countries may take more aggressive stances in trade negotiations or territorial disputes, which could further destabilize the economic landscape and complicate recovery efforts. Conclusion. The projected decline in China's real estate, manufacturing, and technology sectors presents a critical moment for global markets. The implications of this decline extend beyond mere economic figures and involve complex interactions among various stakeholders, sectors, and global competitors. By acknowledging the overlooked content in the report, such as authority bias, income disparities, and the role of technology, stakeholders can better navigate the uncertainties ahead and position themselves advantageously in an evolving economic landscape. 1. China's economic challenges and global implications. The projected 25% decline in China's real estate, manufacturing, and technology sectors by Q2 2025 is a significant indicator of the country's deepening economic turmoil. The fluctuation in GDP growth estimates, which range from 2.4% to 2.8% for 2024, starkly contrasts with the official claims of nearly 5%. This discrepancy highlights systemic issues within the Chinese economy, particularly in the collapsing property sector, which has drastically reduced local government investment and consumption. The implications of this downturn extend beyond China, as global competitors are poised to capture market share in affected sectors. Understanding the interconnectedness of China's economy with global markets is crucial for stakeholders analyzing the potential ripple effects of this decline. 2. Sector-specific dynamics. The analysis reveals distinct challenges across the real estate, manufacturing, and technology sectors. In real estate, despite a pessimistic outlook driven by high vacancy rates and changing work patterns, there is emerging optimism among industry leaders that revenues may recover in 2025. The manufacturing sector, while resilient, is grappling with declining exports and foreign direct investment, indicating a shift in global competitiveness. Meanwhile, the technology sector faces a dual challenge: the need for innovation amidst rising protectionism and the economic slowdown. These sector-specific dynamics illustrate the need for tailored strategies as businesses navigate the changing landscape. 3. Shifts in sentiment and recovery expectations. A notable theme is the shift in sentiment among business leaders, particularly in commercial real estate, where a majority now expect revenue increases in 2025. This optimism reflects a growing belief that the market may be turning a corner after years of decline. The survey results indicate that 88% of respondents anticipate growth, a stark contrast to previous expectations of further declines. This shift necessitates a discussion on the factors influencing this sentiment change, including potential government interventions, adjustments in consumer behavior, and an overall stabilization of the economy. Analyzing the underlying reasons for this optimism can provide insights into future market trends and investment opportunities. 4. Global competitors and market positioning. As China's economic challenges unfold, global competitors are strategically positioning themselves to seize market share in real estate, manufacturing, and technology. The interplay of factors such as rising interest rates, geopolitical tensions, and evolving consumer demands creates a complex landscape for businesses seeking to capitalize on China's decline. The emphasis on sustainability and technological integration is becoming increasingly important as companies adapt to new market realities. This positioning not only impacts competitive dynamics but also raises questions about the long-term sustainability of growth for these competitors. Understanding the strategic maneuvers of global players in response to China's economic situation is essential for anticipating shifts in market leadership and investment flows. Here are 3 famous historical cases that reflect similar themes of economic decline and market repositioning in the face of significant challenges. 1. The Great Depression, 1929 to 1939. The Great Depression was a severe worldwide economic downturn that began in the United States following the stock market crash on October 29, 1929, known as Black Tuesday. The economic turmoil that followed led to a drastic decline in consumer spending, massive unemployment, and a significant contraction in industrial output. The real estate market also suffered greatly, with many individuals losing their homes. In response to this crisis, global competitors began to adapt their economic strategies. Governments implemented various recovery programs such as the New Deal in the U.S., which aimed to stimulate the economy through public works projects and financial reforms. The lessons learned during this period led to new regulatory frameworks and a focus on stabilizing financial markets, which shaped economic policies for decades to come. 2. The Japanese asset price bubble, 1986 to 1991. Japan experienced an economic bubble during the late 1980s characterized by soaring real estate and stock prices. The bubble burst in the early 1990s, leading to a prolonged period of economic stagnation known as the Lost Decade. The collapse had profound implications on the financial sector and real estate markets, with banks facing significant non-performing loans. In the wake of the crisis, the Japanese government and companies had to reposition themselves in the global market, leading to a re-evaluation of investment strategies and a focus on innovation and efficiency. Competitors in the Asia-Pacific region capitalized on Japan's economic difficulties, further altering the landscape of manufacturing and technology sectors in the region. 3. The 2008 financial crisis. The financial crisis of 2008 was precipitated by the collapse of the housing bubble in the United States, which led to widespread defaults on subprime mortgages and a subsequent banking crisis. The resulting recession saw a significant decline in real estate prices, manufacturing output, and technological investments across the globe. In response to the crisis, governments and central banks implemented unprecedented monetary and fiscal measures, including bailouts for key financial institutions and stimulus packages aimed at revitalizing economies. This crisis prompted a fundamental re-evaluation of financial regulations and risk management practices, leading to a shift in market dynamics. Competitors in emerging markets began to gain market share as Western economies struggled to recover, illustrating the interconnectedness of global economies and the need for strategic repositioning in times of turmoil. These historical cases illustrate how economic challenges can lead to significant market realignments and shifts in competitive strategies, similar to the projected decline in various sectors due to China's current economic turmoil. Future outlook. Predictions for the global economic landscape by Q2 2025 amid China's economic turmoil. Predicted economic decline. By Q2 2025, a substantial decline of 25% across the real estate, manufacturing, and technology sectors is anticipated, primarily driven by China's ongoing economic challenges. The projected GDP growth for China in 2024 is expected to hover between 2.4% and 2.8%, significantly below the government's claimed figures as a result of a collapsing property sector and reduced local government investments. This downturn is not only a domestic issue but is anticipated to have ripple effects across global markets, impacting competitors and prompting shifts in market strategies. Sector-specific predictions. 1. Real estate sector. The commercial real estate (CRE) market is likely to face a challenging environment characterized by high vacancy rates and shifts in demand due to changing work patterns. However, there is cautious optimism among industry leaders, with 88% of respondents from a recent survey anticipating revenue increases in 2025 despite the pressures from elevated interest rates and inflation. While the office segment remains vulnerable, sectors such as logistics and multifamily housing may see more resilience and growth potential. 2. Manufacturing sector. Manufacturing in China, which accounts for roughly 30% of global output, is projected to experience declines in exports and foreign direct investment. The sector is navigating through increased competition from global players and the effects of protectionist policies. While the manufacturing growth rate has shown some resilience, hovering above 5%, the outlook remains cautious. Countries such as India and Mexico are positioning themselves to capture market share, potentially reshaping global manufacturing dynamics. 3. Technology sector. The technology sector's growth is closely tied to the performance of manufacturing and real estate. As companies in China grapple with rising protectionism and economic slowdown, investment in innovative technologies may wane. However, there is a burgeoning interest in AI and automation, which could provide avenues for operational efficiencies. The sector is expected to adapt by focusing on integrating AI capabilities while managing risks associated with economic uncertainty. Global competitors' strategies. As China's economic challenges unfold, global competitors are strategically positioning themselves to seize market share. Countries like India, Vietnam, and Mexico are enhancing their manufacturing capabilities and attracting foreign investments, creating robust supply chains to replace those reliant on China. The anticipated 25% decline in China's key sectors presents a pivotal opportunity for these nations to capitalize on shifting production bases, thereby altering the global economic landscape. Key economic indicators to monitor. 1. GDP growth projections. Monitoring GDP growth rates in China and its trading partners will provide insight into the health of global economic dynamics. The IMF projects a potential increase in nominal GDP growth, but this remains contingent on China's ability to stabilize its economy. 2. Investment trends. The flow of foreign direct investment (FDI) into China versus emerging markets will be crucial in understanding where global capital is being allocated. Increased FDI in countries outside of China could signal a shift in competitive advantages. 3. Consumer confidence. Tracking consumer sentiment in China and globally will be essential to gauge the resilience of domestic markets. A decline in consumer confidence could further exacerbate economic slowdowns. For trade relations, the impact of geopolitical tensions, especially regarding U.S.-China trade relations, will be critical. Tariffs and trade policies will influence market access and competitive landscapes. 5. Interest rates and inflation. global inflation trends and central bank policies will shape borrowing costs and investment strategies in real estate and manufacturing sectors. Conclusion: the projected 25% decline in the real estate, manufacturing, and technology sectors by Q2 2025 underscores a critical juncture for both China and the global economy. While China's economic turmoil poses significant challenges, it simultaneously opens pathways for global competitors to enhance their market positions. The future economic landscape will depend heavily on how these sectors adapt to ongoing challenges, consumer behaviors, and geopolitical dynamics. Stakeholders must remain vigilant and agile, embracing innovation and strategic shifts to navigate the complexities of the next few years.